A very good morning to Ms. Shantini, and my name is Joanne Tan, and today I will be presenting the analysis of Tesla, which focus on how the company makes investment decision, how this decision influence performance, and what lesson other organizations can learn from Tesla approach. Next, we go to introduction. Tesla is an American multinational company founded in 2003, and over the last 2 decades, it has fundamentally reshaped both the automotive and energy sectors. The company mission is to accelerate the world transition to sustainable energy, and it pursued this mission through a vertically integrated business model, which includes electric vehicles, energy storage, and solar power. A central pillar of Tesla's strategy is the establishment of large-scale manufacturing facilities known as gigafactories. So these facilities are located in key markets such as Nevada and Texas in United States, Shanghai in China, and Berlin in Germany. Each gigafactory is designed with a specific role. For example, Nevada focuses on battery, while Shanghai and Berlin are carried out final assembly for mass volume models. This global network is strategically structured to enhance supply chain, reduce logistic costs, and meet increasing demand efficiently. In simple terms, Tesla uses skills specialization and geographic proximity to build high-volume, cost-efficient production capacity, which ultimately supports accessibility and competitiveness of sustainable energy solutions. Next, we're going to look at the financial decision-making models. For the break-even analysis, the break-even analysis for Tesla is how to determine how many units a company must sell to cover its fixed and variable costs. In other words, it identifies the points at which sales revenue equals cost, meaning no profit and no loss. In 2023, Tesla estimate break-even price was around 989,282 vehicles based on assumed cost structure for its automotive business. However, Tesla has delivered 1,808,581 vehicles that year, which is far above the break-even threshold. This implies that after covering its cost structure, Tesla has sold approximately 890,299 additional vehicles that contribute directly to operating profits. According to the company's 2023 annual report, Tesla has generated nearly £9 billion in operating income, which supported the estimated contribution margin. However, it is important to acknowledge limitation in this calculation. The analysis assumes that the automotive cost of goods sold are entirely variable, while research and development and selling expenses are entirely fixed. So it also uses average selling price across diverse products, which may distort accuracy. Additionally, segments of energy storage, which have different cost structure, were excluded. Despite this limitation, the results show that Tesla exceeds its break-even price by a substantial margin, reflecting strong operation leverage, high production efficiency, and the ability to convert volume into profitability. Next, we're going to look at the real option theory. Research and development in electric vehicles involves significant technology and market uncertainties. Traditional methods like NPV, net present value, treat uncertainty as a negative potential, undervaluing innovative projects. The real ocean theory, however, real ocean theory recognizes uncertainty as a potential source of upside and emphasize managerial flexibility to expand, delay, or abandon investment. Study how that using real option models can produce far higher valuation for innovative projects that are than traditional models. because they recognize strategy value rather than just near-term financial return. So Tesla key initiatives are best understood as real option, high risk, high potential bets that could be expanded if successful. Tesla full self-driving platform is a major real option that could unlock future business models such as robotaxi service and software licensing. The potential payoff is extremely asymmetric if PS the potential payoff is extremely asymmetric if FSD feels the loss is primarily sunk R&D costs. If it succeeds, Tesla could generate subscription-based high-margin revenue globally. The value of this option reflects not just the technologies, but the massive markets of autonomous mobility in the future. Next is energy and utility skills option. Tesla is also investing heavily in energy storage, including products such as Megapack and Powerwall. To support the skills, Tesla has committed significant capital to new mega factories, including Shanghai. This real option positions Tesla to participate in the global shift from fossil fuel energy to renewable energy solutions. The potential market is enormous and could eventually rival or exceed the automotive sector. This option leverages Tesla technology advantage in battery chemistry and its integrated software ecosystem. Next, we have next generation vehicle platform option. The next generation low-cost vehicle platforms allows Tesla to enter mass market EV segment. Tesla intentionally delayed entry into this segment until it builds sufficient skills, cost efficiency, and manufacturing capability. These strategy delays represent a real option because Tesla preserves the flexibility to expand into a different market segment at more advantageous time. Next, we have supercharger network option. Tesla charging network is transforming from a cost center to a platform business. By allowing other EV brands to use Tesla charging network under a universal standard, Tesla generate new revenue streams. So this option leverage networks, effects, infrastructure control, and switching costs. The last will be Optimus robot option. Optimus, the humanoid robot, represent a high-risk, high-reward moonshot. Although the likelihood of success may be low, the potential payoff is substantial. And the investment cost relative to Tesla skills is manageable. The option reflects Tesla's willingness to invest in transformation innovation with long-term strategy value. Next, we have the communication of investment decision. The first one we have economy of skills. So Tesla aggressively scales production to achieve cost leadership. In 2023, the company produced approximately 1.85 million vehicles across 7 factories on 3 continents. Capital expenditure reached £9.8 million with projection above £10 million for 2024. From 2021 to 2023, vehicle deliveries nearly doubled. However, average revenue per vehicle fell significantly, leading to a major decline in gross margin from 29.35% to 19.4%. This demonstrates a strategy trade-off, sacrificing margins to gain volume, market shares, and competitiveness advantage. So Tesla also maintained the consistent R&D investment around 4% of revenue, despite the profitability pressure. Next, we have the vertical integration. Vertical integration is another cornerstone of Tesla's strategy. Tesla manufactures battery cells, develops software internally, operates a global charging network, and sells directly to consumers. So this approach will provide cost control, technology differentiation, recurring revenue opportunities, and customer experience ownership. So finally, Tesla spent 3.97 billion on R&D in 2023 and incurred 5.15 billion in warranty expenses, indicating full responsibility for product performance. However, vertical integration also exposes Tesla to a higher operational risk. If something fails, Tesla absorbs the full impact rather than a supplier. Yet, if successful, the integrated ecosystem becomes a powerful competitive barrier that is difficult for rivals to replicate. Next, we have post-audit appraisal. For 4.1 assessment of objective, Tesla 2023 performance produced various results. First, production and deliveries exceed the targets. Energy and business scale will be the higher growth. And third, cost innovation is successful, but the margin trade-off. The fourth is AI and FSD leadership improving, but it's not completed. Number 5 is the profitability is strong, but the margin was being declines. So overall, the Tesla balance short-term financial pressure with a long-term strategy goal. And next, let me explain for the internal factors. Internal strategy decisions shape performance, heavy investment in product capacity. Second is the strategy price cut to define the market share, and vertical integration to reduce cost and increase control. Commitment to innovation through R&D and spending. So these choices enable Tesla to sustain volume, competitiveness, and future growth even in a challenging environment. The next will be external factors. The external condition is also a significant shake outcomes. First, we got the US Inflation Reduction Act provided manufacturing incentive and boosted the demand. Supply chain stabilization enabled production ramp up. Competition from brands such as BYD and Hyundai intensified. Inflation and rising interest rate reduce the customer purchasing power. Regulatory credits provide a high margin income stream, and this external force Tesla to respond rapidly while maintaining the long-term strategic execution. Last will be the conclusion and recommendation. Tesla offers insight into how companies in capital-intensive industry can be built sustainable competitive advantage, and this approach Tesla to emphasize long-term innovation, calculating the risk-taking and the strategy flexibilities. So the recommendation, the key lesson that Tesla has been include is to pursue investment with asymmetric upside potential, build optionally by allocating resources by exploratory projects, use selective vertical integration to improve cost stability and product differentiation, and communicate with long-term value creation to stakeholders. So overall, demonstrate how organization can translate early-stage innovation into industry leadership by balancing risk, opportunity, and strategic execution. Thank you. That's all my presentation. Water